Here we go. Welcome, everybody, and thank you for joining us today for our webinar on understanding, or our Aminar, as we jokingly calling them, understanding the Main Street Lending Program Funding Forward. Thank you for joining us today. I'm going to request that everyone please post their questions in the Q&A only. The moderator will not be able to get to the questions both in the chat and the Q&A. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. Later in the day, we will also email a copy to all participants. Briefly about myself, I am the founder and CEO of MultiFunding. I'm an Inc. columnist writing regularly on business lending issues. I've advised prior administrations and the Treasury Department, as well as the Federal Reserve, on business credit markets. I have a book out called The Growth Dilemma, and for my EO friends out there, I am a proud member of EO Philadelphia. Some disclaimers are important. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be reimagining our businesses and thinking about what is next. This is the time to be preparing for battles, as rebuilding, reestablishing, and reemerging our businesses is going to be comparable to a battle. And going into a battle, you need a strategy. Are you going to pivot 5%, 50%, or 90%? A lot of that depends upon your situation and the industry you're in. You need to think about your team going forward, what they look like. And you need ammunition for this battle. And in this context, ammunition is cash, both for offensive and defensive needs. How much cash will be required to get your business back on a stable footing? What is the best case and the worst case scenario? And where will the cash come from, and how much are you willing to personally risk? And what does the future look like? What opportunities will you be considering, and how do you plan to take advantage of them? Today, I'm thrilled to be sharing with you the Main Street Lending Program, which officially opened yesterday. It is part of the CARES Act and has $600 billion allocated towards it. It will be in effect until September 30th, 2020, and is comprised of 3 facilities, a new, a priority, and an expanded. I want to just give all some context. This program is not an entitlement program like the PPP. These are not forgivable. They're loans and they need to be paid back. And they will not be as readily available by every bank in the corner as a PPP. We don't think there'll be more than 200 to 300 banks participating in this program. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank, as it gives them a chance to protect their current liabilities with you or your relationship. It is unlikely, if you've been badly hit, that a new bank will consider your MSLP application. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. Lenders here will be banks, savings associations, or credit unions. There will not be fintechs or other players involved as they were in PPP. To be eligible, you must be established prior to March 13, 2020. If you have more than 15,000 employees or annual revenue in excess of $5 billion, you're not eligible. And you have to be created in the United States with significant operations in the United States. The US eligibility test is to have those significant operations in the United States, When consolidated with your subsidiaries, greater than 50% of your borrower's assets in the United States, net income is in the United States, net operating revenue is generated in the United States. Your annual consolidated operating expenses are also generated in the United States. If you are a subsidiary of a foreign company, you can apply as long as you attest that the money will not go up to your parent and leave the country for that. Eligible lenders are partnerships, limited liability companies, corporations, associations, trusts, cooperatives, joint venture with no more than 49% participation by foreign business entities or a tribal business concern. Ineligible borrowers include developers and landlords and other, such as private equity firms, are not eligible. The Federal Reserve did announce yesterday that they are beginning consideration of a program for nonprofits, but this will be treated separately. If you have affiliated companies or a group of companies that you control, such as a real estate company, your holding company or other entities, you have to consider them on a combined basis. The affiliated groups cannot exceed the maximum loan amount for the facility you choose. And an eligible borrower's maximum loan size would be limited by its own leverage level, the leverage level of the affiliated group on a consolidated basis, and the size of any loan extended to other affiliates in the group. Now let's dig into the facilities. The first two are the new and the priority. They share some commonalities. They are a secured or unsecured term loan. They have a 5-year maturity. Principal payments will be deferred for 2 years and interest payments deferred for 1 year. The unpaid interest will be capitalized. The principal payment you'll have to make a principal payment of 15% at the end of year 3, 15% at the end of year 4, and 70%, almost like a balloon payment, at the end of year 5. They are priced at an adjustable rate of LIBOR on the 3-month index plus 3%. Currently, those rates are approximately, for modeling purposes, you could plan on about 3.25%. Prepayment is permitted without penalty, and the fees are 1 to 2%. Let's talk about the new facility first, between $250K and $35 million. Let's say they have a company, how much you're eligible for a new facility. Let's start with row number 3, a company with $500,000 EBITDA. The maximum on the new facility you could get would be in row 3, $2 million, or 4 times your 2019 EBITDA. But if that company has $1.5 million of drawn or undrawn debt, the total amount you could then get would be $500,000. If that same company in row 1 had $500,000 worth of existing debt, they could get a new loan facility of $1.5 million. What's important is the lender's rights. If you have existing lenders and you're getting a new loan facility, they have to agree that the Main Street lender will have the same rights as them in case you go bankrupt. But in the normal course of business, the new lender's rights can be subordinate to your existing lenders. An MSLF Main Street new loan facility can be secured or unsecured depending on what you can work out with your lender. And it is important to know that you are able to take additional debt after the loan, providing the new debt would not have higher contractual priority in bankruptcy than your Main Street loan. Now let's talk about the priority facility. These loans are between $250 and $50 million. The big difference here is you can go to 6x of your EBITDA instead of 4x. So to take the same company we talked about before with $500,000 worth of EBITDA, they were applying for a priority facility, they could get $3 million. If they had existing debt of $1.5 million, they could get a loan of $1.5 million. That's in row 3. If that same company in row 1 had $500,000 worth of existing debt, they could get a priority loan facility of $2.5 million. What's unique about this program is that not with your new lender, but if you have debt from another lender, you can refinance it into a priority loan facility. But unlike the new loan facility and the priority loan facility, your lender has to have senior or on par rights with your existing lenders in all situations, except for your mortgage lender. And you can make these secured or unsecured depending on what you're able to work out with your lender. In theory, a company with $41.66 thousand of 2019 EBITDA and zero debt could borrow $250,000. Now let's talk about the expanded facility. These start at 10 million and go as high as 300 million. They work on the same basis of 6x of your EBITDA minus your existing debt. So a company to take row two, $10 million of 2019 EBITDA and $50 million worth of existing debt could get a potential new money facility of $10 million. These loans have tag-along rights. They connect to the existing rights of your lender on their senior debt, but the fees are a little less. They're 0.75 to 1.5% to get involved. The rates are the same, and the maturity is the same. For all these facilities, you commit to refrain from repaying the principal balance of or paying any interest on or debt under the eligible loan until the eligible loan is paid in full. You cannot use this money to pay off your old debt faster. You commit not to seek to reduce your committed lines of credit, and you certify that you have a good reason to believe that you will not be going bankrupt in the next 90 days. While you have the loan, you can still repay a line of credit in the ordinary course of business, including a credit card, and you can take on any other additional debt obligations required in the normal course of business, as long as they do not interfere with the rights of your Main Street lender. You're also allowed to refinance maturing debt. You commit to certain compensation stock repurchase and capital distribution restrictions. If you're an S corporation or other certain tax pass-through entities, there are exemptions to allow you to make your tax payments. You agree for while you have the loan and for up to 12 months after the loan is paid in full, not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earned between $425,000 and $3 million in 2019, you can not earn more than that amount in any year you have the loan plus 1 year after. If you earn more than $3 million, say you earn $6 million, what you do is you take the difference between 3 and 6, call that 1.5, you add that to the 3, and your compensation cap is $4.5 million. You agree while you have the loan and for 1 year after to make reasonable efforts to retain your employees. However, unlike the PPP, this is not the main priority or focus of this loan. Your EBITDA will be calculated by lender or your lender. If it is a lender you have worked with before, it will be the same way they have calculated your EBITDA historically. And if it is a new lender, they will have to calculate your EBITDA in the way they have historically done it for companies like yours. That is particularly relevant to what adjustments they might agree to. Your debt will include all outstanding loans and debt facilities, private and from financial banks and bonds or private placement facilities. The existing outstanding and undrawn available debt should be calculated at the date of the loan application. If you have an asset-based line secured by accounts receivable and inventory, the amount of that loan will be of how much you actually have borrowed versus how much you could borrow would be included. How do you pick between the new, the priority, or the expanded? Let's just take example number 2, a company with $4 million of EBITDA and existing debt of $10 million. They could get a new of 6, a priority of 14, or an expanded of 14. It would depend on what their needs are and what they might be able to negotiate with their existing lenders. Financing strategy, my friends, is like offense and defense. Let me just share with you 3 examples of how different borrowers are thinking about this loan. One is a company with a $3 million line of credit and $1 million drawn against it. The line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity. They would rather not personal guarantee the capital required to reestablish the business. I want to be clear, while the Federal Reserve does not require personal guarantees for these loans, in fact, many of the lenders are demanding them. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. So my questions for you is, how much cash would be required to get your business back on a stable footing? What is your best case and worst case scenario? Where will the cash come from, and how much are you willing to personally risk? And what does your future look like, and what opportunities might you be considering? That concludes my remarks. MultiFunding is working with borrowers to help them with these loans if you want our help. And now I'm going to ask Kate, our moderator, to open up the floor for questions. Please be of assistance and put your questions in the Q&A instead of the chat box. It'll just be easier for us. Thank you so much.
Thank you, Ami. Let's get started. Aaron's asking, are you aware of any lenders that are not requiring personal guarantees?
There are some lenders not requiring them on a very case-by-case basis, and it's very specific. It's possible that should the market for these loans become more competitive, they might become a little bit more flexible. But right now, that as there aren't that many lenders participating, they're pretty much insisting on it.
As a follow-up to that, Aaron's saying regular SBA 7A loan rates are about the same as the MSLP, though the term is shorter. Is the value of the MSLP the greater loan amount? Everyone seems to want the personal guarantee anyway.
I really think that's, I mean, these rates are, depending if you're getting a SBA loan secured by real estate or a working capital SBA loan, that affects the rate of an SBA loan. And it really depends on your situation and how much you could borrow on an SBA loan versus a Main Street loan. The benefit of the SBA is that you're going to get a longer time to pay it back. So the cash flow impact is less.
Wilfred's asking, for the priority loan facility, a company with 500K of EBITDA and existing debt of 500K would qualify for the 2.5 million of new money. How would the math work if that company wanted to refinance the existing 500K into the priority facility? Would they then get the 3 million?
They would get the 3 million, but they would get the same cash out of $2.5 million at the back end, because they're getting 3 million, but $500,000 will go directly to the other lender to pay them off.
And he's asking, as a follow-up to that, can a company use MSLP loan financing to acquire a foreign company?
There are no rules about what you can or can't do with the money once you've got it, as long as you don't use it to pay off your existing debt.
Nate's asking, is credit card debt included in current/available debt?
We believe that is the case.
Nate's follow-up to that is, your post this morning mentioned that there will be fewer lenders participating in this program. Is there a best place to locate which of these there are?
It's a lot of calling and hunting. We've built a list for our clients. We have lenders who are participating, and it's taken us a lot of work.
Lee's question is, last year I opened a new location, so my 2019 didn't look very good, but March 2020, I was profiting in all 3 of my centers. I received a PPP and have made it through COVID pretty well. Would like to expand in the near future. Do I have a chance at an MSLP loan if my EBITDA wasn't good for 2019?
The only chance you might have is if the lender considers your startup costs of that new entity as being a one-time event.
Zika's asking, if his company received an SBA loan, can they still apply for an MSLP?
They can, but the rights of that SBA lender will have to be worked out vis-a-vis the Main Street lender rights. So which facility is it going to be? Is it going to be the priority or the new, and what rights will that lender give up vis-a-vis the Main Street loan? So that has to be worked out.
In example number 3, at the end, you indicated funds can be used for acquisitions. We've had a slight decrease in revenue, but have maintained profitability levels due to expense cuts. Are we eligible for MSLP even if we have not sustained a significant profitability hit?
You should be, but really the criteria will be what your 2019 EBITDA was, and then in your debt service is, and how comfortable the lender feels about your forecast.
At the moment, we are caught up.
Good. Anyone, if you have more questions, you got going once, going twice, going thrice. You're certainly welcome to reach out to our office if you have any specific questions or things that situations that you didn't feel comfortable to share in the public group. We're happy to help if we can. And we are excited to be taking many businesses through this program across the country and have built a network of lenders who are doing the program. So, we have one more comment, I think, Kate.
It looks like a question came in. They're asking, what would the timing of funding be for these loans?
We think that it's a little later than I hoped, but that money should start hitting bank accounts in July. Anything else?
Just a thank you. One more. Are the big banks such as Chase participating?
Seems to be that the big banks are only considering it for existing clients and not open to considering it for new clients, at least right now.
With the extensions to the PPP, can you address that for just a bit?
I think you have to evaluate your, after 8 weeks, how much forgiveness you would be eligible for. If the vast majority of your loan will be forgiven at the end of 8 weeks, it might make sense just to be done with it. But if you're at a 60, 70, 80% forgiveness ratio, there's a good chance it makes sense to wait out the 24 weeks. So my advice is evaluate it for how you're doing after 8 weeks. And then if you're not doing great, try to rejig it so you can hold the 24. But if you've got it all forgiven or almost all of it forgiven, apply for 8 and then get it done.
Aaron mentioned that Chase is participating, and Sue is asking, do you charge fees for helping?
We do charge fees for helping our clients with the Main Street program. We're happy to provide this educational information for free, but we are charging our clients fees if they want us to hold their hand and take them through the process, package up the loans, take them into our network of lenders and get the loans, help them get the loans done. Any other questions? All right, folks, I really appreciate your time. I know these are tough times, but hope everyone keeps their head up and moves forward. So on that note, we thank you so much and wish you all Godspeed. Take care now. Thank you. Bye-bye.